Alright, so we have to talk about beautiful Australia, where everything is trying to ruin your life. Box jellyfish, swole kangaroos that look fresh out of prison, venomous snakes, terrifying spiders, and the scariest of all of these, Australian real estate.
It's never been harder to find somewhere to live.
Rents have hit a new record high.
Record highs.
Weekend after weekend, people are lining up, fighting for the few places left on the market.
It's so hard.
A lot of them feels like you don't have a chance.
There is no doubt right now we are in a rental crisis.
The median home price in Australia's 8 capital cities is now approaching almost $1 million. Now, of course, the price of a house doesn't really mean much until you take into account how much someone makes, and there's a couple major problems. In the last couple of decades, home prices in Australia have quadrupled while incomes have only doubled. And let me just show you something called the price-to-income ratio. This is just a measure of how much a house costs in comparison to people's incomes, and this is using middle ground data, or the median. Now, a healthy, normal, good price-to-income ratio is supposed to be between 3 to 5 times someone's yearly income. So for example, if you make $50,000 a year, your Zillow search parameters should be between $150,000 to $250,000. Now is also a good time to share with you that one of my toxic traits is going on Zillow and criticizing homes I'll never be able to afford. Like this white bathroom, which is just too modern and too clinical. Now, in the United States, the median price-to-income ratio is a little over 4. Now, if you looked at a list of the top 10 most expensive price-to-income cities in the world, you'd find 3 Australian cities on that list. In 9th place, for example, is Melbourne, where a house is almost 10 times the median yearly income. And in 2nd place is Sydney at almost 13.5. And thanks to interest rates going up, it's put a huge strain on renters and people with a mortgage. Over 1.5 million Australians are now considered to be at risk, which is anyone whose mortgage payment represents between 25 to 45% of their after-tax income. So in today's video, I want to help explain exactly what is going on, what caused this housing crisis, and what we can all learn from history on the evolution of the theory of economics. This is going to be super interesting, so let's get into it. G'day mate, my name is Andrei Jikh, hope you're doing well, come for the finance, and stay for the Rise Up Lights. That's not razor blades, that's Rise Up Lights. Smash the like button if you found that useful, and smash the dislike button if you— oh no! I'm sorry, that's not how Australians talk, and I've probably offended everyone, but now let's talk about the housing market. Because the question is, if the market is in a bubble, and it shouldn't be going up as much as it is, why is it that the Australian housing market went up by 11.9% in 2023? And the basic explanation for why it's happening is more or less the same around the world. We've had historically low interest rates for over a decade, which made it easier to borrow money, and it encouraged people to buy investment properties. And as people and investors bought more properties, there were less available on the market, and that was made especially worse after the 2020 pandemic, when interest rates were dropped even more.
National home prices in Australia have risen 33% since the onset of the pandemic. At the same time, interest rates are markedly higher.
In the last couple of years, the cost of renting nationally has spiked. Eye-watering numbers going up faster than inflation and wages. All of a sudden, we're spending more and more of our income on rent.
And now we're in this weird timeline of events where everyone is waiting for prices to come down, but instead they're going up. And this is happening because interest rates are high today, which means no one wants to sell their house and trade their lower interest rate for a higher one, and because no one wants to sell, we have less homes available on the market than we normally should. That's what economists call macroeconomic reasons, or big picture things that are true for most of the world. But there's a much more interesting story that explains how we actually got here. And that story started hundreds of years ago.
Well, ladies and gentlemen, we're here to sell. So we open the bidding, ladies and gentlemen, at 1,100,000. I thank you for that, sir. 1.5. At 1,600,000 I have. Wholesaling at 1,918,000. Sold, sir. Congratulations. Ladies and gentlemen, have a great afternoon.
That busted house sold for almost $2 million. How though? The answer is land. And to really fully understand this story, we have to look at Physiocrats. A Physiocrat is a word for 18th century economists because back then, in the 1700s, all economists believed that it was agriculture that explained the gap in wealth between someone who was really poor and someone who was really rich. Because if you were a landlord and you owned your land, that meant you controlled the labor of the land and the produce, and that meant you had money. If Physiocrats were the Squirtles in this analogy, then the classical economists who came after them were the war turtles. They were the next step of the evolutionary economic theory. That's all thanks to the rise of something called the Industrial Revolution. Classical economists had a more expanded point of view of what made somebody rich. They thought it wasn't just the land, but it was a combination of land, money, and jobs. But land still played a pretty big part of their equation. Now, after the Industrial Revolution, though, the world sort of settled down, and we got the next step of the evolutionary economic theory, which are the 20th century economists, aka the Blastoises and their hydro pump and dumps. Their belief is that it was the efficiency of capital and the job you had that determined how rich you were. By the way, efficiency of capital is just a fancy way of saying how money gets invested. So think of Warren Buffett, angel investors, bankers, hedge funds, and those are just examples of people that don't necessarily make anything useful for the world. Instead, they make money by allocating their capital, by investing their money. And notice how in this modern equation, land is not a big part of the variable. It's only a part of this equation to the extent that it gets treated like capital, but it's not its own separate variable that we really pay attention as much as we should. Now, it's this Blastoisian point of view, you could say, that creates economic policies and tax breaks that favors those with capital. And those with capital are, of course, investors. And if you live in Australia, you're probably familiar with at least two of these economic policies that people criticize are a big part of the reason why Australian real estate has become so unaffordable. And number one, there's something called the capital gains tax discount. And this is a policy that says if you hold an investment, like an investment property, for more than 12 months and you go to sell it for a profit, you only have to pay for half of the capital gains taxes. So for those in the highest tax bracket of 45%, they would only have to pay 22.5%. And some economists argue this is one of the biggest reasons why home prices went up as much as they did after its introduction. Now here's another example of a policy that favors capital. It's called negative gearing, and here's how that works. If the cost of your investment property is more than the money that you make from it, you can use the difference to deduct from your taxable income. So for example, let's say you make $100,000 a year and your investment property is generating $10,000 a year in rental income, but it also costs you $20,000 a year in things like taxes, depreciation, and maintenance. So now you can use the loss to offset your income. So now that's a $10,000 loss, which you can subtract from the 100 to get $90,000 of taxable income instead of paying taxes on the full 100. Now, critics of this policy say that this creates an unfair tax advantage for investors because a lot of these costs are not real out-of-pocket, out-of-your-wallet kind of things. Instead, they are paper losses like depreciation, which they don't actually have to pay. So that means that leaves them with more money in their wallet. And when you combine both of these policies, it incentivizes those with capital to take out a loan, to get a tax break on the loan, to rent out their property while they make an income, and while it goes up in value, once they're done and they want to sell, they'll only pay for half the taxes that they should. All of which, again, incentivizes those with capital to buy a house, convert it into a rental, and thus drying up the overall supply. Now, because economists have ignored land as part of this equation for so long because they preferred those with capital instead, it has led to many countries around the world, including Australia, to becoming a nation that is struggling to pay its rent.
We've got very strong demand to rent, and that continues to outstrip the supply of available rentals.
Less than 1% of the country's rental properties are available for occupancy, which is the lowest among comparable markets globally. And the tight supply partly explains why rents for houses and apartments surged by 16% and 20% respectively in the past year alone.
So not surprisingly, the people that are most affected by this are the younger people and people with lower incomes. 1 in 5 working households right now who rent are in financial stress, which is defined as skipping a meal, using charity, pawning something, or not heating their houses. And one of the most heartbreaking parts about all of this is that it was actually a lot better in the past. In the 1990s, for example, the average Australian needed to save for only 7 years for a down payment, and home ownership peaked at 71% in 1966. It was amazing. 3 out of 4 people who lived in Australia in the 1960s actually owned a house. But fast forward to data from 2021, and only 40% are homeowners for people ages 25 to 34, and that number is all the way down to 28% for the lowest income in that age bracket. And nowadays, it takes the average person 12 years to save for a down payment. But in the long term, the people that this will ultimately end up hurting the most is going to be everyone. anyone who's planning to get old someday and retire. Data shows that almost half of the retirees ages 65 and up that rent today live in poverty. And that makes sense because your housing cost is going to be the most expensive monthly payment in retirement. Because if you don't own a house by the time you're 65, if you have no income because you have retired, you're either going to have to live way below your means or continue working way past retirement. So it's a very bad sign for any country that has an increased rate of renters and a decreased rate of homeowners, which unfortunately, in today's world, is true for most of the modern economies. So pop quiz, we learned about the 3 different economic theories, and the question is, which one had the best idea? The Squirtles, the Word Turtles, or the Blastoises? Time's up, you are the weakest link, goodbye. The answer is all of them. All of them had the right idea because those ideas are what dominated in their lifetimes. But now in our lifetime, we've come to this interesting point where our economic ideas have to evolve again. Because by ignoring land, we've created all these problems of housing shortages, unaffordability, and homelessness. And to drive the point home, no pun intended, I just want to show you how important land has become to consider into our economic theories once again. Data shows that 80% of all the goods and services Australia creates is made on only 0.2% of land. Just think about how mind-blowing that number is. 0.2% of land creates the majority of goods and services that Australia makes. And that's because most of what Australia makes is concentrated in what are called CBDs, Central Business Districts. Now this is true for the entire world, but for Australia specifically, places like Melbourne and Sydney alone account for 10% of Australia's economic output. These are just some examples to say that businesses are willing to pay a premium to exist within these CBDs because that's what gets them closer to their suppliers, to the skilled workers they might hire, and to their customers. And to the people that live in Australia that might want a job, they're also willing to pay a premium because that's what gets them closer to those opportunities. All of which to say, that's what led to the increase of these central business districts, that's what increased the land value, and that's what has created more and more competition, which has led to higher rents and mortgages. So the question is, what is the solution? And if I knew the answer to that question, I wouldn't be making videos on social media, I'd be in charge of economic policies and running countries, but here I am on YouTube making videos solving the world's problems one video at a time. But based on the limited research I did do for this video, some economists say that we should take land into consideration a lot more than we do today. Land as far as land values and how we tax the land. Because at least according to one of the sources that I used for this video, for most advanced economies, rising land values accounted for 80% of the growth. So economists argue that we should increase taxes on land that is owned by investors, especially if that land is not productive and it's just sitting there and it's vacant. So that's one possible solution. Another one is just to make it easier to build more houses. In the COVID era, Australia only had 400 homes for every 1,000 people, which is nowhere near enough the amount that Australia actually needs. The importance of land has evolved throughout history, and now owning land is becoming important again. And my theory, this is why people like Bill Gates started buying up farmland. They understand it's important to own again because they've realized the cost of capital is cheap. Rich people can borrow money very cheaply. Countries can print more money very cheaply. What we can't do more of is print more land. And a lot of the wealthier people realize that they could just buy the land, they could hold on to it, rent it out and make some income, and when they're ready to sell, they could get a tax break. But that's just a film theory. So I just want to give you my personal opinion, even though no one asked, but you can be one of 2 people in this world. First, you can be someone who spends the rest of their life being angry and upset at the people and the policies that got us here, and you'd have every right to do that. Or you can be person number 2, which is someone that understands everything I explained in today's video is a byproduct of our life. This is the time period we are living through, and we didn't choose to be here, but we are here. And eventually, these economic policies and theories will evolve, but maybe not within our lifetime. So if you're someone who wants to take life into their own hands, and maybe someday you decide to call Dave Ramsey and ask him for advice, here's what I think he'd tell you. Eat rice and beans. And then he'd tell you, maybe get a skill that pays you more, work remotely, and definitely move away from these central business districts where it will cost you a lot less money to buy a house. I hope you found this useful. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks, links are down below, and then go track them automatically with the spreadsheet link down below in my Patreon. Love you. Thank you so much for watching this video. I'd love to see you back here on Monday and Friday, sometimes a Wednesday. See you soon. Bye-bye.